Welcome to this month's Economic Update. I'm Sinead Rafferty, Portfolio Specialist at NAB Asset Management, and I'm joined today by our Senior Economist Bob Cunneen. Welcome, Bob.
Thanks, Sinead.
Bob, we saw solid returns from offshore global markets in the month of September. Can you give us a bit of colour around how the different regions performed?
Yes, so the global share market was up about 0.5% for September, and we had a similar performance in both the American and European share market. But what's noticeable, Wall Street is clearly surging ahead. So if you looked at the S&P 500, the broader share market index, what you can see, it was at record highs. So from that point of view, America's share market is running on the strong corporate profit story and the very favourable momentum, positive growth story out of the United States in terms of high business confidence, corporate tax cuts, solid jobs growth. So that's all supporting the American share market. Against that, Europe's disappointed this year. So Europe's had these concerns about Brexit and the new Italian government. So while it did better in September, it has disappointed this year.
What about China, Bob? How's that performed? There was a bit of an escalation in terms of the trade wars with the US. What's been the impact on share markets in China?
Well, China's share market, if you looked at the domestic market, say the Shanghai index, that was actually up 3.5%. But if you looked at some of the larger cap markets that are listed on Hong Kong, they actually disappointed. So we're getting a very mixed performance out of China. And what's really a concern for China at this point in time is that President Trump has announced extra tariffs on another 200 billion of imports from China. So that adds to the previous 50 billion of tariffs. So from that point of view, the trade tension has escalated. Now, what's helped share markets in China at the moment is that the central bank looks like it's adding liquidity into the financial system and trying to lower interest rates. So that is helpful for the economic growth, profit growth story in China. So we're still in a wait and see with China in terms of the trade issue.
Okay. You mentioned interest rates. We did see a rise in interest rates in the US in the month of September, but as flagged and fully expected, what has been the impact of that rise in borrowing costs and rise on bond yields in terms of the impact on markets?
Yes, so the Federal Reserve raised interest rates in September. So that's one source of upward pressure on bond markets. But the other source is concerned about future inflation risks in America. So you've got very low unemployment, you've got wages growth starting to accelerate, you've also got very strong rises in oil prices. So this indicates that future inflation risks in America are becoming quite intense. So that's why the Fed at this point in time is raising interest rates, but the bond market is telling us that they may need to do much more in terms of interest rates over the next 12 months to 18 months.
Okay. You did mention there a rise in oil prices. What was behind that?
Well, there are some supply concerns. So we've got sanctions against Iran. So America has announced all these sanctions, which potentially take about 2 million barrels of oil off the global oil market. We've also got some doubts about the supply of shale oil in the United States. So there's concerns that this ramp up in production that we've had over the last 5 years is not sustainable. So potentially we're facing a shortage of oil over the next year, and that's what's driven up the oil price.
Thanks, Bob. Finally, what about the Australian share market? How's that performed in the month of September?
Well, the Australian share market was an exception. It actually fell 1.2% for September. So we had particular weakness in the healthcare sector. It was down about 7%. We also saw utilities such as electricity and gas companies. They were down roughly around 3%. So that was disappointing. Against that, some of the commodity stocks, energy stocks did particularly well because what we're seeing is rising oil prices and quite resilient iron ore prices at the moment. So that's helping the profit story for the resources companies.
Thanks for your time, Bob.
Thanks, Sinead.
And thank you for joining us.